you're good.
It says recording rate. Okay, good. Thank you. All right, guys. Sorry, more technology problems. So, now we are going to continue our talk about chapter 6. So if you will remember, a couple chapters ago, we talked about cash methods and how it impacts the timing of income. Well, now we're going to revisit all of those topics on cash methods, but we're going to talk about how it affects deductions, okay? The rules are the same. The way that they work out in reality is a little bit different with deductions. So with a cash taxpayer, expenses are deductible only when they're paid, okay? So if you have a cash method taxpayer and they are paying their electricity, they have to actually write the check or send or charge it to their credit card. It has to be actually paid to be able to take a deduction. Just a second, let me get to my notes. So there is a rule with cash method taxpayers that if the benefit or the useful life extends beyond the end of the tax year, it must be capitalized. So when we use this word capitalized, what we mean is they do not get a current deduction for the piece that does not relate to the benefit in that year. So when we're talking about deductions, you often hear the word expense or expensed and capitalized. Two verbs. Expensed means you get an immediate deduction. So you get a current deduction. If you hear someone say, or me say, this is expensed, that means you get a write-off or a deduction this year. If you hear the word capitalized, that means you may have to wait, or you don't get it at all, depending upon the item. When we say something is capitalized, that means you get to take a deduction piece by piece over time. The timing of those deductions is different depending upon what item you're talking about. Okay? So that's kind of the terminology with deductions. It's either expensed or capitalized. And often you'll say it's a little confusing because if you hear the word expense, that's a noun, okay? An expense can be capitalized, okay? An expense can be expensed, okay? If you hear it as a noun, like you say, I have an electricity expense of $500, that just means I had a cost that I had to pay of $500. Whether it is expensed or capitalized is a different question. Okay, so that is a little confusing, but terminology. So, for a cash method taxpayer, if the benefit or the useful life extends beyond the end of the tax year, it has to be capitalized. So let's look at a problem. Let's look at example 7 on page 6-8. In example 7, we have John, who's a cash method taxpayer, and he pays rent to Carl. On July 1st, 2016, he pays $24,000 in rent. This is John, okay, for 24 months of rent ending June 30th, 2018. So he's getting 2 years of benefit from this payment. So according to this general rule, is he going to be able to expense all of it in 2016? No, part of it is going to have to be capitalized. Which part? The part that relates to the benefit outside of 2016. Since he's getting 6 months worth of benefit from this deduction in 2016, he's going to get 6 months worth of this deduction. So at $24,000 of rent for 24 months, that's essentially $1,000 a month, right? Times 6 months is $6,000. So 6 months times $1,000 equals $6,000. Okay, deduction in 2016. And then he'll get a $12,000 deduction in 2017 and a $6,000 deduction in 2018. Okay, depending upon when he receives the actual benefit from his payment. Or you could do this with a proportion, say 6 months over 24 times 24,000 equals 6,000. Same thing. Okay. Now, there is an exception to this rule over here. It was actually created by the Supreme Court, created this exception. It's called a 1-year rule, okay? Under this exception, to make sure I say it right, if it will not be consumed or used, whatever, depending on what type of deduction you have, consumed by the end of the tax year following payment, no capitalization. I'm sorry, I should say if it will be. It's written down in the book. If it will be consumed by the end of the tax year following the payment, there is no capitalization requirement. So we basically have a time frame put in place, okay? So let's look at this problem right here. Does the exception apply to this problem, okay? It was for the last 6 months of 2016 and goes over into 2018. With this time frame, does this qualify for this exception?
No.
No, right? Because the end of the tax year following payment would be what? December 31st, 2017, right? End of the tax year following payment. If it doesn't, it goes over into 2018, so this does not qualify for the exception. But what if instead of paying $24,000 of rent, he paid $12,000 of rent for 12 months going into June 30th, 2017. Now, does this qualify for the exception? Yes, right? Because the benefit or the useful life of the payment does not extend past the end of the tax year following payment, or December 31st, 2017. So that means he gets to take a current deduction or an expense of $12,000, okay, because he will fall under this exception. Okay? Now let's talk that was example 8, by the way, the one that I just did. Now let's talk about accrual method. So if you will remember, when we talked about accrual method, we had 2 tests that were important, the all events test and the economic performance test. These tests are still relevant when it comes to deductions. So there are 3 requirements for an accrual method taxpayer to take a deduction. The first one, all events must have occurred to create the taxpayer's liability. Two, the liability can be determined with reasonable accuracy. The amount of the liability can be determined with reasonable accuracy. And third, the last requirement, or the economic performance requirement, is when the service or property giving rise to the liability is actually performed or provided. So let's look at an example. This is example 9 in the book. In this example, we have an accrual basis taxpayer on the calendar year who has a contract to clean up after a college concert. The concert is on, or a festival, something like that, is on December 22nd, 2016. Because college is not in session for a while, he cannot actually get there, they're closed, to clean up after the event until January 4th. He has, on January 4th, to clean up, he has $1,200 of labor. So he wants to know, can I expense this in 2016 or 2017? Well, let's go through the requirements for an accrual basis deduction. All events must have occurred to create the liability. Has that happened in 2016? Yes. Right? The concert has happened. Okay, it needs to be cleaned up. He has a contract to clean it up. Can the amount be determined with reasonable accuracy? Probably. There's probably a contract in place that says how much he's going to get paid. And third, the service or property giving rise to the liability is actually performed or provided. Did this happen in 2016? No. So he cannot take the deduction until 2017. Now, what if this taxpayer also had a contract to set up for the concert? Okay? So he had $12,000 of setup of labor costs to set it up. Can he take this deduction in 2016? Well, here, all events have occurred to create the liability. Yes, he's setting it up. The amount can be determined with reasonable accuracy because he has a contract for $1,200. And have all events occurred or been performed? Yes, if this would be 2016 because he actually does set up in 2016. Okay? He pays his employees in 2016. All events have occurred, just for the setup fees, if he was setting up. Doesn't say that in the problem. But if he had a contract to set up and clean up, the setup piece he would get to deduct in 16 because that has actually been performed. But if he was cleaning up, he couldn't clean up till 2017, so it wouldn't be performed until 17, this piece of it. Okay, we'll see how that works. All right. There are some exceptions for economic performance tests. For recurring items, and you can take a look at the exceptions in your book. It's on page 69. You can deduct recurring items if all of the following conditions are met. It is recurring in nature. Either the accrued item is not material, or accruing it results in better matching of income and expenses. The all events test has been met, so these two still have to be met. This is just an exception to this. Okay? And performance occurs within a reasonable period. So performance occurs soon. So if you look, there are a couple examples. Example 10. We have Rick, an accrual basis taxpayer. He entered into a monthly maintenance contract during the year. He makes a monthly accrual at the end of every month for the service and pays the fee sometime between the 1st and 15th of the following month when services are performed. The amount involved is immaterial, it's recurring, this part of the test is met, so in that sense it's an exception and we allow him to go ahead and take the deduction currently. Okay? It's on methods of accounting. So now we are going to talk about some things that are not allowed as debt, as a deduction, that maybe you would think that they would be. The first thing I want to talk about is public policy. If you have a deduction that is contrary to public policy, penalties, fines, bribes, or kickbacks, penalties, fines, bribes, etc. These are not an allowable deduction. So if you get a speeding ticket on the way to visit a client, that is considered to be a fine, and you cannot take a deduction for it. You will remember Dr. Payne, in our facts at the beginning, he was fined $3,000 by the city for failure to dispose of medical waste properly. That is not an allowable deduction. You cannot deduct it because it's considered to be a violation of public policy. Legal expenses. There are two situations where you can deduct legal expenses. The first one is in conjunction with a trade or business, I put T or B, trade or business, or income producing item. So basically, something related to producing income. Okay? Something kind of business related, not personal. So remember, under Code Section 162, if it's trade or business, under 162, which we talked about last time, is an above the line expense or below the line? Above. Okay? Now, what about 212? Would this be an above the line expense or below the line? It depends, okay, on what it relates to. If it relates to rent or royalties, it's above. If it relates to anything else, it's below, generally speaking. Okay? The second scenario, you can deduct legal expenses, is for taxes. You pay an attorney for the determination, collection, or refund of a tax. Okay, that's pretty much everything you could do related to tax. Okay? Then that is going to be a deduction. If it's related to a trade or business, it's an above the line deduction. For anybody else, okay, if it's related to a trade or business or rental royalty, I should say, it's above the line, okay? So if it's trade or business and some 212, it's above the line, okay? All else, including regular people not involved in a business, okay, it's an itemized deduction, or below the line, and it's subject to a 2% floor. Okay? Actually subject to 2% floor here too, actually. If you fall under this category. And below the line. So, and we'll talk more about this 2% floor here. Maybe today, probably not till next week, how it works. So if you're looking at Schedule A, which is where itemized deductions are reported, there is a category at the very bottom that says miscellaneous deductions subject to a 2% floor. This is one of those items, okay? This and this. Okay, that's it on legal expenses. And I will say, let me note this. If you fall under this category in conjunction with a trade or business, okay, it doesn't have to be related to taxes. It can be related to anything, so long as it's related to the business, okay? Some examples up here, a landlord's legal fees associated with eviction of a tenant, okay? So that would fall under the income producing item, right? This is 212, okay? Which would be above the line. Above the line. If it, another example, a corporate officer's legal fees in defending against price fixing charges. So that would be trade or business. Okay. Okay. Illegal business, which to me is the same thing as public policy. If you have an illegal business, you can deduct expenses, business expenses. There is an exception for controlled substances. If you're in the business of drugs, illegal drugs, okay, then the only deduction you can take is cost of goods sold. So it's kind of funny, right? Because if you're operating gambling in a place where it's not allowed, or a prostitution ring in somewhere other than Nevada, then you can take all your regular business deductions. It's not a problem. As you can imagine, a lot of people don't report any income or deductions for obvious reasons. But this is a good way that criminals can get caught. Like Al Capone was caught because he did not pay his taxes on his illegal mobster operations. If any of you have seen Zootopia, the little bunny tries to get the little criminal, and the criminal said, "Oh, well, I've made $1 million a year for the last 15 years or whatever. I've outsmarted you." And then the little bunny says, "Oh, really?" Because she hadn't reported. She said, "Oh, really? Well, you don't have any tax returns filed." So, people did. Anyway, it can be a good way to get people who are otherwise sneaky and are getting away or hiding things. Can be a good way to get them. Because if it's fraudulent tax evasion, that's a criminal offense and you can go to prison. You cannot get the death sentence for it, but you can go to prison for a long time. But if you have a drug business and you're selling cocaine or marijuana or whatever, the only expense you can take is cost of goods sold. Okay? So, there you go. And of course, somebody always asks, well, what happens if you're in a state where marijuana is legal? How does that work? Then, I don't really know the answer to that. But, I believe the answer, I don't know if it's discussed in here or not. I don't think it is. I think it doesn't really say in the book. And there's a little section on ethics and equity on page 613 where it kind of raises this question. I mean, the reality is the IRS doesn't necessarily care, what the state's stance is on that item. I mean, I know I've heard people can still get federally indicted for possession of marijuana, even if you're in a state that allows it, because federal law trumps state law. You have to have over a certain amount to be federally indicted for possession of marijuana. I think it's a lot, right? But anyway, so federal law can still step in and say, we don't care what state law says, this is what we're going to allow. Okay. So, okay. Lobbying activities. If you pay for a campaign, that is not a legitimate deduction. You can't take a deduction for that. There are some minor exceptions for lobbying expenses. This is slide 23, if it's to influence local legislation, that's allowed. If it's to monitor legislation, that's allowed. And if it is a de minimis exception for in-house, which is up to $2,000. Okay, and if you have more than $2,000, you can't deduct any of it. Alright, and back to our big picture facts. If you'll remember, Dr. Payne contributed to the campaign of 2 senators. These are not deductible expenses, so he doesn't get a tax benefit from them. I'm going to skip this. I don't know why it's in this book. This is an issue for corporate tax, which is not this class, so I'm not tested on this. I don't know why it's not difficult, I just don't know why it's here. Okay. The next topic we're going to talk about is investigation of a business. So this is an important topic. For one, it's always tested on the CPA exam. So if that's a route you're looking to go, learn it. And for another thing, it will be tested in this class. So what this is talking about is you have someone who is looking to acquire a new business, and they have expenses related to this acquisition. Costs include travel, engineering, architectural surveys, marketing reports, legal and accounting services. And I will tell you, currently in my practice, I do some acquisition work, people buying and selling. I did 3 years doing M&A work at PwC, and the fees for legal and accounting services can be outrageous, okay, when you're looking to buy a new company. So, so the question is, are these investigation fees deductible? Well, it depends. It depends. There are 2 categories the taxpayer could be put into. So the first question you want to answer is what category they are in. If the taxpayer is in a similar line of business to the company being acquired, that's the first category. The second category is if the taxpayer is not in a similar ... Okay? So either the taxpayer is in a similar line of business or they are not. The answer to this question greatly affects the deductibility of these expenses. So if the taxpayer is already in a similar line of business to the company being acquired, the expenses are deductible in full immediately. Okay? Whether or not the new business is acquired. If the taxpayer is not in a similar line of business, we have a different answer. If the new business is not actually acquired, there is no deduction of these expenses. If the new business is acquired, there are special rules for deduction. You get to the expense immediately. $5,000 of investigation expense, okay, with a $1 for $1 reduction if over $50,000. And the residual, or whatever is left, must be amortized over 180 months. So amortized means capitalized, okay? They have to take a deduction over time. So let's look at a problem, okay? This is example 22. In example 22, Tina owns and operates 10 restaurants located in various cities throughout the Southeast. Okay? She travels to Atlanta to discuss the acquisition of a car dealership. Okay? So she owns restaurants and she wants to buy a car dealership. Okay. First of all, are we going to be in this category or this category? Two, right? This is a completely different line of business. Okay? And she has 52,000 worth of expenses. And she acquired the business on October 1st, 2016. How much of a deduction is she going to get to take in 2016? So the first thing we have to look at is this $5,000 of expense. Now, because her expenses are over $50,000, we have a dollar for dollar reduction of that $5,000. So we say $52,000, which is her expenses, minus the $50,000 limit over here, the threshold, okay, which is $2,000. So there's a $2,000 reduction in the $5,000. So she's going to get an immediate expense in 2016, okay, of $3,000, right? 5 minus 2 is $3,000. Plus her piece of the amortization for 2016. Please remember when you're doing these problems, the amortization starts in the year of acquisition. You don't have to wait till the next year to start amortizing. It starts in the year of acquisition. So, if she's amortizing, how much is she going to get? Well, she had $52,000 of expenses, right? And she gets an immediate deduction of $3,000. So how many do we have left? 49. 49,000 to amortize. This is what she's going to amortize over 180 months is 49,000. Please note, this number is not 47,000. Okay? You don't start with the cap at 50 and subtract 3. That's not what you do. You take the actual amount of the expenses, which are 52, and subtract how much she's getting an immediate deduction, which is 3. So we have 49 left to amortize. How much does she get to amortize in 2016? 3 months worth, right? October, November, and December. So 3 over 180, which equals $817. So she gets to take an immediate deduction in 2016 of $3,817. In 2017, how much of a deduction is she going to get? Okay, so she'll still have her $49,000 base, but in 2017 she has 12 months to take advantage of the amortization over 180. Okay? So this would be 2017. Now, what happens if Tina's expenses, instead of being $52,000, were $60,000? Everything else is the same. Now what? what is the amount she gets to take as an immediate deduction in 2016? What does she get? Does she get the $5,000? No, she doesn't get it at all. Why? Because we have a dollar for dollar reduction for anything over $50,000. If she has $60,000 of expenses, really this dollar for dollar reduction only matters if you have expenses between, $50,000 and like $55,000. Okay? So, or I should really say $50,000 and $50,001. Okay? And on up. So she has $60,000 of expenses. The only deduction she gets in 2016 is her amortization piece, right? So $60,000 times 3 months over 180 is all she's going to get in 2016. Which, if someone has a calculator, calculate it. If
It's
not,
1,000.
you know how to calculate it. Right. Someone who's good at mental math. $1,000. Oh. Okay, you didn't have to. So. All right. So. That's it for investigation of a business. Make sure you know how to do it. Actually, let's look at this one thing. Let's go back to Dr. Payne's facts. Okay? So Dr. Payne, and remember he's a dentist, and he's looking at buying Teeth Restoration LLC, a local dentist practice that's for sale. Is that going to fall under category 1, which I just erased, or category 2? 1. Dr. Payne does not end up buying it. He doesn't think it's a good investment. Does he get to take the deduction still? Yes. Does he have to worry about this limit? Nope. Gets the full deduction. Okay? This limit only matters if you fall under this category. Okay. Great. Next topic is hobby losses. If you will remember last time, we talked about Code Section 162, Code Section 212, and then I briefly mentioned hobbies. So these are really the 3 different categories, and which category you fall into depends upon profit and participation, right? So 162 is the highest threshold. This is trade or business. You're very involved. This is your livelihood or the majority of your livelihood. You definitely want to make money. This is how you support your family, etc. 212 is a lesser standard of participation, like investing in stocks, having rental properties, royalties, something like that. Okay? Now we're going to talk about hobbies. Hobbies are even less than 212. This is like stamp collecting, gambling, racing horses. If you look on page 617, Exhibit 6.3 lists some of the things that are considered to be hobbies. Dog breeding, craft sales, bowling, auto racing, fishing, horse breeding, farming, photography, art, etc. So these are the things that are, obviously there are lots of things, but commonly classified as hobbies. Now, why do you care if it's classified as a hobby? It matters for the deduction of your expenses. If it's a hobby, you can only deduct expenses to the extent of income. And your deductions are itemized, okay, and are largely limited by a 2% floor. So we have this 2% floor conversation again. Probably won't have time until next time to actually get into the mechanics of the calculation, okay? But know that this is the rule. So this is why taxpayers care if it's classified as a hobby. Because if it is, they can only deduct their expenses to the extent of income. And they only get to deduct their expenses if they itemize. And even if they do itemize, their expenses have to exceed 2% of their adjusted gross income in order to be able to take the deduction. Huh?
It's very rare.
Right. So it's not, I mean, we're going to do a calculation next time, and you will see what I don't think we're going to have time today. And you will see how this works out, okay? So taxpayers care. I have represented a client before, and they did horse racing. And they very much cared, and they had a lot of losses, as people who do horse racing often do. And they wanted to take all their losses. So you get into this argument. Is it a hobby or is it not? At what point do we cross that threshold between hobby and business? There is a threshold. There is a point. How do we get there? Well, let's talk about that right now. Okay? So there are two ways to get there. There is a presumption. If there is profit for 3 out of 5 previous years, it is presumed a for-profit endeavor. So if it is a for-profit endeavor, it is not a hobby. Okay? Or there is a 2 out of 7 profit presumption for horse racing. So if the taxpayer can prove that they have had profit in this endeavor in the 3 out of 5 previous years, it is presumed to not be a hobby. It will either be 162 or 212, depending upon what kind of business it is. Depending on what they're doing. Now, there are also a list of factors. I am not writing them all on the board. But they're in your book on page 616 and 617. And there is a great chart on page 618. It's concept summary 6.2. I definitely encourage you to take a look at that chart on page 618. This discusses these factors. Let me read them out to you. Whether the activity is conducted in a business-like manner, the expertise of the taxpayers or their advisors, the time and effort expended, the expectation that the assets will appreciate in value, the taxpayer's previous success in conducting similar activities, the history of income or losses from the activity, the relationship of profits earned to losses incurred, the financial status of the taxpayer, elements of personal pleasure or recreation in the activity. So, what this means, let me tell you how this plays out. Let's say you have a taxpayer and they qualify for the 3 out of 5 profit test. That means they are presumed to not be a hobby. So to be a for-profit endeavor. Okay? But the IRS doesn't like it. They disagree. Now the IRS can come in and argue these factors. So the IRS can overcome this presumption. Remember, all it is a presumption. It does not mean if you meet this test, you are for-profit. It means you are presumed to be for-profit. And the IRS can disagree. And how they get there is with these factors. Okay? So you've heard, right, that you can get a DWI even if you choose not to blow if the officer thinks that you look intoxicated, right? Okay? Same thing. They're not meeting the technical requirements of the 3 out of 5 years, or they do meet them, but the IRS is using these factors to arrive at a different conclusion. And as you might guess by me reading them, these factors are highly factual, right? You're writing memos, you're making arguments to the IRS, okay? You may do this sometime, okay? Accountants do this too. Now, what happens if you have a taxpayer who doesn't meet the test? Now, that taxpayer is presumed to be in a hobby. But these factors go both ways. The taxpayers can use the factors to their advantage to overcome the presumption. Okay? So just because a taxpayer doesn't meet this test, that does not necessarily mean that it's a hobby. The taxpayer can still use the factors to make an argument. Are they probably going to have to hire an attorney or an accountant to write something up to get them there? Yes, they should. Okay? But they can't, these factors can be used by either the IRS or the taxpayer to either's advantage. Okay? So please know that's how it works. Let's look at a problem here in the book. Okay, so these are the years for this entity. Okay? In 2009, or this endeavor, there was $500 of income. Is this presumed to be a hobby? Yes, because there was not a profit in 3 out of 5 prior years. There have not been doing this endeavor for 5 years. In 2010, there was a loss of $1,500. Is this presumed to be a hobby? Yes, it is a hobby, not for profit, because there was not profit in 3 out of 5 previous years. 2011, $700 in income, still a hobby. 2012, $1,000 loss, still a hobby. Now in 2013, we had $900 of income. So let's see, is there profit in 3 out of 5 years? 1, 2, 3. Yes. So now this taxpayer has a for-profit endeavor. And we're depending upon what it is, they'll fall under either 212 or 162. Okay? Now in 2014, this is on slide 34, the taxpayer has a $500 loss. Now do they have profit in 3 out of 5 years? Prior years? 1, 2. So no, they don't. Now the taxpayer is a hobby again. Now in 2015, are they hobby or are they for profit? 3 out of 5 years. 1, 2, 3. So now the taxpayer is in a for-profit endeavor again. Now remember, this is only applying the presumption. There are still factors. A good target for the factors is 2014. This would be a good place to say, okay, you don't technically meet the presumption, but let's look at the factors. One of the factors is history or income or loss from the activity. You didn't meet it in 2014, but you met it in 2013. If it was me and I was making that argument, I would say, hey, you know what? Maybe we just had some extra unexpected expense in 2014, maybe environmental cleanup or something. We don't expect that it will happen again. We really have, some, for the foreseeable future, we see profits again. And in fact, in 15, they did have profits again. So that would be a good place to bring in the factors for the taxpayer's favor and try to get them back into for-profit, even though technically they do fall out of the presumption, right? Do y'all see how that works? Okay. All right. Okay. So, we don't really have time. It will take a while to get through the problem. So when we come back next week, we are going to do a problem on hobby losses. We're going to talk about rental income. Okay, those are two big things, and the two big things from this chapter, which you definitely will have problems on the exam. And a couple other minor things are covered in this chapter, but those are really the big things. And we may or may not have time to get into the sample 1040 on Monday. It's looking like probably not. That's okay. We'll just do it on Wednesday.